So here's another question on the capital asset pricing model chapter, and we're going to look at betas once again. But now we're not going to solve for the portfolio beta. We're not going to solve for the new portfolio beta, but we're going to solve for the individual beta. So the beta of an individual security, just one single unit. It's going to be interesting. Okay. So in this question, or in this video, I guess, you'll see how I would go about solving this question or solving exam-like questions when I'm preparing for my final exam or my CFA Level 1 or even my grad studies or anything of the sort. So here's how we go about it. The first step will be to read the question and identify key pieces, while also thinking about the formulas that we have at play within CAPM, especially within betas. And then it's always fun because it's a game of finding the missing piece of the puzzle. You don't need to look at whether we're dealing with a growing annuity here, right? We're simply looking at maybe one or two formulas related to CAPM. So just focus on identifying those parameters and nothing else. I really could not stress that enough. Okay, so let's go about doing this. I guess we'll identify the formulas. When we're in CAPM, just please remember that you have really two formulas, one for the SML, in other words, like the classic CAPM formula, and then one for the beta, how to find the beta of something, okay? So really as easy as that. So let's identify the two very important formulas we need. One will be the one for the SML, then one will be for beta. All right, so let's go about doing that. All right, I guess I'll put them in different colors, and we could even zoom in just a little bit just to write kind of nicer and also so you really have the information in front of you. So the SML, it's simple. It solves for the required rate of return on an asset, and it's equal to RF plus beta times the market risk premium. So ERM minus RF, literally as easy as that. Whereas beta, in other words, the beta of a portfolio, that's what we really care about, could be written like this. Beta of a portfolio will be equal to the sum of, or I guess the weighted sum of its individual securities. Now I always kind of like butcher what this means, but that's why I take the time to kind of draw it up in a different way. That makes beta a little bit easier to internalize. So as much as beta could be written like this, I guess in like an alien language, we could also write the formula for a portfolio's beta as being slightly easier, okay? Something that's like they could actually internalize, if you know what I'm saying. And if I'm always looking here, it's because my face cam is here, and I want to like at least not look like a weirdo, or to try to like not look as much as a weirdo if I can. So we could write it as being something like this. So the beta of a portfolio is equal to the weighted, or essentially the weight of asset A times the beta of asset A plus the weight of asset B times the beta of asset B plus the weight of asset C times the beta of asset C plus three little dots to pinpoint or highlight this sense of continuity, the sense of us doing this, you know, forever. And then we're going to add the weight of the nth asset times the beta of the nth asset. I always use the following example. So let's say we had a portfolio that comprised only of two stocks. Well, then you would stop here. You would do the weight of A times the beta of A plus the weight of B times the beta of B. In other words, you do the weight of the first asset times the beta of the first asset plus the weight of the second asset times the beta of the second asset. And then basta, you're done. You don't need to continue because we only have two assets. And if we had three, well, then we would stop here. And if we had infinity, well, we would stop at infinity. So never really. But you get the general idea, okay? So now that we've highlighted the two important formulas we need, it becomes pretty straightforward what we need to do, because we're literally just going to identify these different parameters within these two formulas, and we're going to try to use them at our advantage to solve for missing variables, okay? So let's read this question together, and I guess I'll switch colors just for the heck of it. So Bridgewater currently manages a $5 billion portfolio. That's insane. The firm is expecting to acquire a portion of JP Morgan's portfolio that is valued at $2.5 billion. Good for them. The existing portfolio, right, of Bridgewater has a required rate of return of 10.75%. So this means that the K of Bridgewater is equal to 10.75%. So technically, if you wanted to look at our two formulas that we've highlighted up top, we could say, all right, well, technically, it seems that we already have a K. Cool. So we already have the output of the formula. Typically, when you see that, this means that you're going to have to solve for something within the right-hand side of the formula, okay? You're going to have to solve for something here. So just have that in mind. It's like some taking tests 101 type of thing. Then we know that the risk-free rate is equal to 4%. Look at that. We can highlight pieces of our SML formula again, okay? And they're telling you once again, yeah, if we want to highlight it onto our prompt, the risk-free rate is equal to 4%. This is literally how I used to, do my questions on my own. Always highlight the stuff, always have your formula on the side, and try to create a link between the two. That's really the best way of going about this. And then we're telling you that the return on the market is 9%. This is amazing. We had the RM as well. So already we kind of know that we're missing one little thing, and that's beta. But let's continue reading the question. Then they're telling you that if Bridgewater wants the required rate of return of their new portfolio, that's pretty interesting, to be 11.5%, what should be the average beta for the new stocks added to the portfolio? So what should be the average beta? Unfortunately, that's not written, so I'll have to make those adjustments. But they want to know what will be the average beta for the new stocks that were added to the portfolio. And they want that their new portfolio, so K prime, to be equal to 11.5%. All right. So they want to know what will be the average beta for the new stocks added in the portfolio, knowing that they want a required rate of return of 11.5% for their new portfolio. So there's, this could be, there could be a lot of noise here where it's not too clear what we need to do, because they're talking about betas, but we don't even see one beta in the whole prompt. So it's getting kind of strange. So if we were to look at our formula here for the SML, we notice that we're definitely missing beta. But what's awesome is that we have all of this amazing information highlighted in yellow, such that solving for the missing part becomes really easy. But even then, what do we do after that? Okay, what do we do with that? It's getting a little bit weird. So let's take a step back and let's try to make sense of what this question is really telling us. Okay, just think about it. We're Bridgewater, okay, we're this big company. You don't even need to think about it as being a big company. But we're a company that manages a portfolio, okay? We're a company that manages a portfolio, and that portfolio is of the size of $5 billion, okay? And we're telling you that we want to buy a new portfolio. We want to buy JP Morgan's portfolio, okay? And we're going to add it to our portfolio. That's what they're telling you, right? Because they want to know, well, once we add this to our new portfolio, this will for sure have some repercussions, right? And one of these repercussions or one of these consequences is us wanting a higher required rate of return. In other words, this probably means that our beta will be higher because we're taking on a new portfolio, perhaps with new risk. Another thing that I'd like to note, though, is that the size of this portfolio is going to be equal to $2.5 billion. Okay, that's going to be really interesting. And let me just throw more context at you. If we invested, okay, I'll use a different color here. No, actually, do this. Just going to do a little trick here. Okay, cool. So we're invested in Bridgewater, and we're invested in JP Morgan. Okay, so we have $5 billion invested in Bridgewater, and we have $2.5 billion invested in JP Morgan. So if you're able to do some quick maths, you notice that now the total amount of money managed by Bridgewater, right, because they purchased JP Morgan, will be equal to $7.5 billion. Okay, that's going to be important later on in the question, but it's important now to just make that just have that key takeaway in mind. Okay, so Already, if you didn't know what to do, you would just plug in the stuff within your formula and just try to play around with the information provided. Because notice one thing, that once you have the missing beta, you're also given a new K. You're given a different K. And that different K may be useful for us, right? We may be able to do something with that. Because that different K could also be plugged in within our formula here, right? And from which we'll be able to get a new beta, okay? So anyways, we'll start step by step, and hopefully that will give you some context on what to do, all right? So let's just do that. I don't know what color I want to use. Let's go ahead and green. So part A, I guess, I'll go here. Part A would be solve for missing beta. All right, part A is solve for missing beta. That's really, really easy to do because once again, we have our K, which is 10.75%. We have our risk-free rate, which is equal to 4%. Then we don't have our beta. Then we have our return on the market, which is 9%. And once again, we have 4% right here. So if you were to plug all of that in, you could simply solve once again for beta, right? We could solve for it super quick. So then you would say the beta of Bridgewater's fund would be equal to, we go look it up together. So we could solve for it together. We would say 10.75 is equal to 4 plus x times 9 minus 4. Let's see what we get. We're going to get something along the lines of 1.35. So that's going to be our missing, sorry about that. That's going to be our missing beta, 1.35. So that's amazing news. And with that, we could actually plug all of that good stuff in within our second formula. Well, what do you mean second formula, you may think? Well, think about this. We now have a different required rate of return once we purchase a different portfolio, right? Think about it. Notice how I did all this little math here? Well, once we have incorporated JPMorgan's portfolio within our fund, well, our risk factor may be different. And because of that, they told you in the question that we require more returns for that given level of risk. But we don't know what that given level of risk is just yet. In other words, we don't know what that beta is just yet. So we need to plug that stuff in and solve for the new beta under the new portfolio. So I guess we could write this here as being part B, solve for beta after JP. Solve for beta after we've purchased JPMorgan, okay? So this one is also going to be very straightforward. Once again, now we know that our required rate of return has shifted. It's shifted to 11.5%. However, our risk-free rate is the same. It's 4%. We know that we don't have our beta yet, so we got to solve for that. And the return on the market remains at 9%, and the risk-free rate, of course, is 4%. So then we could solve for the beta. I guess we could call it beta JPMorgan. And that's going to be equal to, by the way, that's not the beta of JPMorgan. It's really the beta after Bridgewater has purchased JPMorgan, okay? And then in this case, we plug all that good stuff in. Instead of 10.75, we're going to have 11.5, I believe, yes. And we're going to notice that the portfolio beta will now be equal to 1.5. All right. So you may be like, okay, listen, I get the whole game of we need to solve for what's missing, blah, 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 blah. But what do we do with this once we get here? Well, it's actually pretty straightforward now, because now you know what will be the portfolio, or I guess Bridgewater's portfolio beta. You know what it will be once they've purchased JPMorgan. As you can see on the screen, it'll be, whoops, 1.5, okay? And that 1.5 is going to be crucial for us because for us, this is synonymous to the beta of our portfolio. So I could even zoom in a little bit just to write a little bit cuter for y'all. This will be synonymous to the beta of our portfolio. And now we could start moving a little bit. Now we could, like in French, actually I don't even know what's my expression. It's moving, like ça bouge, ça donne. Okay, it's going well. So we have the beta of our portfolio, and we know that the beta of our portfolio is a composition of its individual betas. Okay, and what's awesome is that we could also find, well, the composition of our portfolio now is composed of two things. Okay, let's visualize this once again. If we could even go at the top of the screen here, we know that a portfolio consists. I'm trying to make it nice. There you go. We know that our portfolio consists, right, of two funds. It consists of Bridgewater and it consists of JPMorgan. Now remember, 5 billion is for JPMorgan, for Bridgewater, sorry about that. And then 2.5 billion is for JP. So what we could do is we could actually find the weight, right? The weight associated to each of these. And what's awesome is that you notice that, I'll write this here in blue, that 66.67% is allocated to Bridgewater, and that 33.33% is allocated to JP. Those are the weights, okay? So in other words, that would be the weight of asset A and asset B. Think about it. Weight A would be for Bridgewater, so 66.67%, and weight B would be for JPMorgan, which would be 33.33%. And once again, what's awesome is that we know the beta of Bridgewater. The beta of Bridgewater, we have it right here, it's 1.35. So that's amazing news. However, we don't know the individual beta, put it in red, of JPMorgan. So now we can actually figure out, well, what has to be the average beta for the new stocks incorporated by JPMorgan by just solving for this missing variable, okay? So it's a lot of, talky, but it definitely helps. So we could just look if my math is correct. So it's good. I'm okay with that. Okay, so now we can move on to part C. So solving for the individual beta. And yeah, we'll stick with this color, why not? So part C. This. And we're going to say solving beta B. Okay? So once again, think about this. We know that the beta of our portfolio is equal to the weight of A times the beta of A plus the weight of B times the beta of B. And what's awesome is that this is a very easy scenario because we understand that we literally only have two different investments here, technically. We have the Bridgewater fund and we have the JPMorgan fund. And we already know the beta of our portfolio once we purchased JPMorgan, okay? This is with the purchase. So we know that our portfolio will be equal to, our portfolio beta will be equal to 1.5. 1.5 times essentially 66. You could write 2/3 if you want, it'll be easier. So the weight of A would be 2/3 times the beta of A, which is going to be 1.35, plus 1/3, which represents their investment in JPMorgan, times the beta of JPMorgan. So as you notice, once again, this is the information that we don't have, and we just got to solve for X. This will literally be our X. We call this X. And then by just plugging everything in within our little calculator there, we would get that the beta of B, if we plug everything in, so let's see what we get. 1.5 7 plus x 3. And we're going to get something along the lines of 1.80. 1 point, I'll write all the decimal points, but you may be like 1% away, which is fine. So there's a small margin of error. But as long as you're around this, you should be good. And this would be the answer. This would be the beta of JPMorgan stock. Now, I know that this is a lot of information. I know that we went literally across the world, but this would be a very good depiction of how to solve for individual betas, okay? This is how you would go about it. This first step in this type of question, this specific one, was, all right, we have all this information. And if you like think about it too, and I'm sorry once again if I'm jumping from one point to another, but now I'm structured. If you think about it, every single question we do at ISMA Helps, it's very much a game of figuring out what chapter are we in, and then figuring out within that chapter, what are the concepts that you need to remember. For CAPM, it's beta, the CAPM formula, maybe pricing, maybe alpha. In this case, in this specific question, it's obvious to us. We're going to need to use the CAPM formula, and we're going to need to use the beta formula, the portfolio beta formula. So then, you should really do this. Just have the formulas on hand in front of you, on the screen, on your paper. Then read through the question. Identify all of the parameters that fit within that formula. There's really nothing else that you need to do. Like, I don't know in what language I need to say this. And once we've done that, we notice, okay, amazing. We have our K, we have our RF, we have our return on the market, and we have, once again, our RF, such that the only missing component was beta. All right, and that led us to the first part, which was solving for that missing beta. Now we know that Bridgewater's beta prior to the acquisition of JPMorgan's portfolio was equal to 1.35. Awesome. But then the question also probes you with the notion of, well, hey, your required rate of return will change once you purchase JPMorgan. The reason why is because now your fund is larger. Your fund is now with different assets. And because of that, we require higher returns. And if you understand SML at this point, if you understand CAPM, the higher return you want, the more risk you're exposed to. And because of that, we need to find, well, how much more risk are we exposed to? What is the metric for risk? It's beta. So how did our portfolio beta change? So what did we have to do? We had to do the same thing as part A. We had to solve for the missing beta because we have our K, which is K prime, right? 11.5%. We have our RF. We have our return on the market. We have our RF again, right? If we look at the formula, such that the only thing that you need to solve for is beta. You do that, you get a new beta, a beta that's obviously higher, a beta that's equal to 1.5. That's the new portfolio beta. Now they're asking you something interesting though. They want to know, well, hey, what would be the average beta? So what would be the beta of the new stocks or the new fund that was added to the portfolio? We could take a high level view. We could say that our portfolio is built out of two assets or two different, entities. One would be Bridgewater's fund, and then the second one would be JPMorgan's fund, such that our total fund would be essentially a sum of parts of those two, such that we would have essentially the weight of Bridgewater and the weight of JPMorgan. We could even make that easier for us. We would have the weight of asset A and the weight of asset B. We noticed that it was 66% for Bridgewater and 33% for JPMorgan. That's amazing news. And what's even better is that, well, if we look at our formula for the portfolio beta, we actually have a bunch of information. We have the portfolio beta, which we solved in part B. Then we have the weight of A and the weight of B just by reading the question. And of course, we are only missing one part. We only have two things to look at. We're missing the beta of B, which is quite literally what the question is asking from you, which is quite literally the mission of this problem, which is finding the beta, the individual beta of that missing, of that added asset, of that, of that acquisition. And then in part C, you just got to solve for it. It's basic algebra. right? You plug in all of your information, you get that the beta of JPMorgan, right, is of 1.80, and you're done the question. Really take a step back, right? Like try to have like a journal about what we just talked about. Really make sense of it. Because on an exam, that kind of like logical framework is important. But really the first step to take, put all problems, if you're watching this video before the other ones, please always have your formulas with you on your paper. Have it written. That's what I do. That's what PhDs do. That's what everybody does because it makes the problem solving process much, I mean, like a million times easier because you know what you're looking for. Then it's just a question of like placing them in within your formula, solving for the missing variable. I hope this was helpful. I hope this gave you some context on how to solve an exam-like question on betas. If you want to have, I literally sound like I'm doing a pitch, but if you want more resources, just go on my YouTube channel, go on my website. Literally, just look up Isma Helps on Facebook, Twitter, Google. You will find a bunch of resources. And that's why I'm here. I want to make this whole thing free. I want to make this whole thing accessible for you. Like students should learn in a non-static way, right? Everything is so static. And my bad, I hurt my shoulder not too long ago, so I did this. And ooh, it hurts. But everything is so static lately. And this is just an attempt to give you a comprehensive view, like a really good, breadth of like resources and content that you could use. I sound like a loser, but to learn. So hopefully this helps you out. And let me know if I made a mistake, by the way. So yeah, thank you. See you later. Enjoy my content, and hopefully it helps.